If you can keep investing $100 a month, which is less than $4 a day, from the day you turn 21 until the day you turn 66, you do that for 45 years, you never change how much money you invest, and you just get an average stock market return, which historically has been 10% a year. That doesn't mean you get 10% growth every year. It means on average, you grow by 10%. You are going to retire a millionaire with your $4 a day investment. The problem is, what happens if you spend your 20s having a good time,
right,
partying, enjoying, trying to figure life out? Then in your 30s, you're trying to figure out your career. You're just like trying to buy a house, get married, do all that stuff. And then your 40s come and you're like, oh, let me start thinking about retirement. Now what? Because if you start investing when you're 45 and you start with that same plan where you invest $100 a month when you're 45, trying to retire by 66, and you can get the same 10% annual return, well, if you start when you're 45, you're not going to have $1 million. You're not going to have $750,000. You're not going to have $500,000. You're not even going to have $250,000. You're going to retire with about $100,000.
Wow.
That's not enough to retire. And so this is where now, if you start investing when you're 21 or younger, great. You know, the numbers show you that, hey, if you just keep compounding small amounts for a long period of time, you can become wealthy, even if you start with just $4 a day. But if you don't start when you're 21, then what? And this is the situation that most people are in, because most of us don't grow up learning about money.
Exactly.
Most of us are not given any sort of financial education. Most of us have no idea what investing is when we graduate. Most of us don't know how to do these things, when to do these things, what to do. And so now if you're watching this and you're 30, you're 40, maybe in your 50s, what do you do? How can you become wealthy? Can you become wealthy? And the first answer is yes, because, well, it's been done. And so, you know, if you don't believe it's possible, just take a look at, I guess, some of the history. Like Vera Wang has started in her 40s, became very successful. The founder of Gap started after he was 40. There's a lot of people that started after the age of 40 and still became very successful. And you can do this even if you're not an entrepreneur, even if you don't have the next great business idea. It's just using your money the right way. But the first thing that you have to do, did I say first enough yet, is you have to understand the mindset aspect. Because if you're sitting there telling yourself, it's too late for me, I can't do it, it's too tough for somebody who looks like me, somebody with my background cannot become wealthy, then yes, I guarantee you will not be able to become successful.
Right. Because
if you don't have the right mindset, it is going to be impossible for you to become successful, when in reality, for 90 to 95% of people, if you have the ability to hear what I'm saying, understand what I'm saying, and you are in a first world country, it is not a tool set issue. We think that we're lacking the tool set, we're lacking something that can make us successful, but in reality, it's not the tool set, it's your mindset. And that's the first thing that you have to understand, that if you want to become successful, now regardless of your age, you have to first adopt a growth, successful mindset. Now, what does that mean? It means first, you believe that you can do it. You wholeheartedly believe that you can do it, because what happens is your mindset dictates your actions. Because now if you believe, hey, you know what, I can become successful, what are you going to do next? You're not just going to run around and say, I'm going to become successful. No, you're going to actually start researching. You're going to go to YouTube and you're going to start researching, how do I become successful? You have a bunch of free videos there. And then you're going to start reading books. And if you're like me and you don't like reading, you're going to start using Audible. Start listening to books. I was actually just on, like right now before this, a podcast where the host was asking me similar questions, like where can they start learning? Where can people start learning? Well, obviously start with YouTube, because it's a free resource. It's super accessible. And then second, go on to Audible and just search whatever it is that you want, whether it's money management, investing, starting a business, entrepreneurship, biographies. It does not matter. Pick one of these categories that you want to learn from. Find the top 10, 20, 30 books in terms of ratings. Read all of them. And that is going to be now your MBA for less than a few $100. You just saved $100,000 and you are going to learn even more than your MBA by reading these 30 books. I promise you. And so now this is just, again, whatever it is that you want to learn, whether it's money management, investing, building a business, or something else, find the top books there and go and learn it and read it and then apply it. Because now you have to be willing to fail. Because now when you tell yourself you're going to do it, now you start learning. Then the next thing that's going to happen is you're going to try something and then you're going to lose. You might lose money. You might feel embarrassed, but that's a part of the process.
Right.
Because now, again, it goes back to the mindset. If you believe that you can do it, then the next thing you're going to say is, oh, I screwed up. Let me try again. Let me do something else. Let me see where I messed up. Oh, this is how I messed up. Let me go do something else. Every successful person has gone through this. And every time you screw up, what you're doing is you're finding another way that it didn't work, which pushes you one step closer to finding how to do it.
Mm-hmm.
I've talked about this openly on YouTube. Like I've talked about my worst real estate deal ever.
Right.
It was a very painful deal, a very stressful deal, and a very expensive deal. But I learned so much during that one real estate deal that it helped me get set up for much bigger and much more profitable deals. But I had to go through a lot of pain. You got to be willing to get punched in the mouth, to get kicked in the throat, as Tom Bilyeu says. I was just on his show recently, so he was talking to me about that, so it's in my mind. But you have to be willing to get literally, like, it's tough. You have to be willing to get hit and then get back up. And that requires you to get out of your comfort zone. Now, how do you get out of your comfort zone? How do you get comfortable doing that? Well, sometimes forcibly putting yourself out of your comfort zone. Maybe go and take an acting class. Maybe go and take a singing class. Maybe go and become a stand-up comedian. Now, you might think, what is that going to do in terms of me becoming financially successful? Well, if you are scared to get out of your comfort zone, if you're scared about what other people are going to think, if you're scared about, taking these types of risks, forcefully do that. It's a little bit more comfortable when you're, I'm going to go take an acting class. Now you're forcing yourself to do something you're not comfortable with, or you're going to sing or do comedy, something that you feel the most scared about. Go and do that. Because once you can conquer that, then you're going to realize, oh, maybe if I sell my Beamer and I drive a Toyota Camry and everybody starts making fun of me, I'll be okay with it.
Right.
And so it's being comfortable with yourself. You're trying to build your own self-esteem. You're trying to build your own confidence, because the reality is now to go and become successful, it's going to take sacrifice. Everybody has to make sacrifices, and it's easier when you're younger, but it's one of those things where everybody has to put in that sacrifice, and you have to be willing to put that in. And how do you practice for that? Just get yourself out of your comfort zone. And so you have to develop this right mindset. There's tons of videos on YouTube about it. There's tons of books out there for it. And you're going to see that some people speak to you about mindset better than others. And you just have to figure out what you like and start applying that and learning it. So first thing, right? How do you do it? You got to have the mindset. I'm calling myself the minority mindset because all success starts with your mindset. If you don't have the right mindset, it is going to be impossible for you to become successful.
Absolutely.
The next thing then is we got to dig a little bit of a foundation, right? You want to build a big building, you got to dig a foundation first. And you got to do that with your finances. And the way that you do that, practically speaking, is twofold. First, you want to save a little bit of cash, because if something bad happens, your car breaks down, your kid breaks their arm, your window breaks, you don't want to go into debt to go fix that problem. You want to have some cash saved up to protect you against an emergency, because the reality is life happens. It's a part of life.
Right.
So you want to just protect yourself from it by having a little bit of cash, because the reason why so many people get into a bad financial situation is because they're not prepared for a bad financial situation, because we never expect it to happen, when in reality it happens. They have always happened. It's like saying, oh, the market's never going to crash. It's happened every 8 to 12 years for the last century. Like, it happens. So instead of getting blindsided by a potential accident happening, be prepared for it, putting aside some cash. The flip side to that is paying down your high interest debts. Things like your credit card debt, things like hard money loans, things like when you go and borrow money at 0% APR but don't pay it off in time, and now you have a 22% interest rate. Pay these things off first, because they are literally skinning you alive. In the beginning of this video, I talked about how if you just invested $100 a month and you got a 10% return, how you would retire a millionaire. Well, let me give you another one. If you were 21 and you had $6,200, which is the average household credit card debt right now in America, if you had $6,200 when you're 21 and you invested that, and you never invested another penny again, and you were able to get a 20% return on your money, and you did that year after year until you turned 66 when you retire, you would retire with north of 15 or 20 million dollars.
Wow.
It's a lot of money. And that's with a $6,200 investment, assuming you never add another penny to it. Now, the next question is, Jaspreet, where in the world am I going to get a 20% return? Well, you're right. You might not be able to consistently, but guess who is? Your credit card company. They're the ones that are getting rich off of your credit card debt. So what you need to do is pay off that debt as fast as possible so your credit card company isn't getting so rich off of you, because it might not seem a lot. You're making the minimum payments. Yeah, you're paying a little bit of interest, but these things add up over time. And if you don't pay it off now, you're going to pay it off over time, and it's going to cost you even more. So you got to do whatever you got to do to pay it off. That means live below your means, earn some extra money, stop spending so much money. I think Dave Ramsey says if you have credit card debt, you shouldn't see the inside of a restaurant. Honestly, he's not wrong. You better not be spending money on anything foolish if you have credit card debt. This is the time for you to be paying it off as fast as possible, because right now it is skinning you alive. So pay off the credit card debt. So that's what you want to do now after you build the mindset. After you have that, you've paid off the credit card debt, you have a little bit of cash put aside. Now you can start thinking a little bit bigger, because there's no point for you to invest your money in the stock market and try to get a 7 to 10% return when you're paying 20% on your credit card. Like, it makes zero financial sense. So before you think about investing your money in stocks, real estate, crypto, it does not matter. You should not have any credit card debt. So now that you've paid it off, this is where you can think a little bit bigger about how do we now actually build wealth? Because the reality is your savings will never make you wealthy. You cannot save your way to wealth. It is physically impossible, because your savings are losing value to inflation each and every day. We've talked about this on YouTube countless times.
A lot.
And so you need to understand that. And so now, how do you become wealthy? Investing your money. How do wealthy people stay wealthy? By investing their money. So if that's how wealthy people become wealthy, and if that's how wealthy people stay wealthy, how about now we start implementing this into our own lives by investing ourselves? Now, the nice thing is you don't need a lot of money to invest. Now, a lot of times people will say, well, I need like 10 grand to start investing or for it to be worthwhile. But that's not true. You're holding yourself back. Remember what I said in the beginning. You can start with $4 a day, a $100 investment. And if you start that early enough, it will turn you into a millionaire. The numbers say that. If you don't believe me, go pull out a compound interest calculator and try it out yourself. So it's all about the time and the small increments. So it doesn't matter if you're starting with $1,000, $10,000, $100, or even $1. The key is you have to get started. And the nice thing about being alive today, in this day and age, is there are so many apps out there that make it so accessible. With as little, literally, as $1. There are apps out there that will let you start investing with $1. If you want to see my recommended apps, there's a handful of them in the description of this video. You can also check out our website, theminoritymindset.com, where we publish a ton of reviews on different apps. So if you want to learn more, you can check that out. But there are so many resources out there that make that accessibility of investing so much more simpler than before. So there's no reason not to start in terms of the accessibility. The second reason is the education, which now if you're watching this video, you know the reason why you need to be investing. But now, if we speak more practically, how do you do it? And this is where you want to create a system where every time you get paid, some of your money is going to be invested, some of your money is going to be saved, and then you can spend the rest. Because what wealthy people do is they invest their money, meaning they pay themselves before they make everybody else around them rich. But what the majority of people are doing is they spend their money, they make everybody else around them rich, and then if they have any money left, that's when they'll invest it and save it. That's when they'll put the money to work for themselves. And so this is where you have to kind of flip the script and start thinking about, okay, if I want to become wealthy, I got to pay myself first. Before I go out and make Gucci rich, before I go out and make BMW rich, before I go out and make Apple rich, before I go out and start buying that double guac, I got to make myself rich. So what does that mean? You got to invest your money. So if I create like a very simple, very basic financial plan, this would be creating something like a 75, 15, 10 plan where for every dollar you earn from now on, anytime you earn a penny or a dollar, it's going to flow through the system. But for every dollar that you earn, 75 cents is the maximum that you can spend. 15 cents is the minimum that you're investing. And 10 cents is the minimum that you're saving. Now, once you do this, you have a system that can scale with you. Whether you're making $20,000 a year or $200,000 a year or $20 million a year, that system will scale. And now what you're doing is the more you earn, the more you invest, the more you save, the more you can spend. And the only thing that's going to change is your savings. Because like I was saying in the beginning part of this section is you can't save your way to wealth. It's impossible because of inflation. And so what you want to do is you have to understand, why do you save? Why do wealthy people save? You want to save your money for three reasons, and 3 reasons only. You want to save your money for an emergency in case something happens like life. You want to save your money for an investment, or you want to save your money for a big purchase. You want to buy a car, you want to buy a house, you need cash to do that. If you're not saving your money for one of these 3 reasons, you don't want to save because now your savings are just making you poorer each and every day. So how much money should you save for an emergency? Well, this is going to depend on you, where you are in your life, and your risk tolerance. You want to save somewhere between 3 months and 12 months worth of expenses. So if you're 23 years old and you got very little financial responsibilities, you could take a lot more risk. You don't got a spouse, you don't got kids. Well, now guess what? You might only need a few months worth of expenses, and now you have a solid savings account. If you're older, you have a spouse, you have kids, now maybe you want more than 3 months. Maybe you save 4 months, 6 months. Maybe you don't like risk. You just want to be completely financially secure and never have to worry about money. Then maybe you save 9 months or a year's worth of savings expenses. I don't think you need more than a year. After that, you're really getting a little excessive. Don't save more than that. But this is where now you can figure out kind of where you are in your life, your goals, and your risk tolerance to see how much money you should save for your emergencies. After you save that amount, don't keep saving that money. Put your savings to work in your investments. So now it can become 75-25. Now, how do you invest your money? Well, I talked about the 5 places I invest my money. I invest my money into my business, market briefs. I invest my money into startups, which is also number 1. Then I invest my money into real estate. I invest my money into stocks, cryptocurrency, and physical gold. These are the 5 places that I invest my money in this order in terms of biggest to smallest part of my portfolio. Now, does it mean you should copy me? No. But understand that there's many different ways that you can invest and many different strategies to invest. Like the simplest thing that you can do, again, not easiest, is create a system where not every time you get paid, your money, a percentage of your money automatically gets withdrawn out of your checking account and gets invested into either index funds or ETFs that give you exposure to the markets. It's automatic, it's consistent, and it's passive, and you don't have to worry about it. It happens by itself, and over time, we're talking about over not months or years, we're talking about over years and decades. This can make you very wealthy if you just let it happen, no matter what's happening in the markets, whether the market's up or down, and you don't touch it. It has been proven time and time again to work. But it requires that consistency, and there are so many apps that let you do this for free. Again, if you want to know where, go to our website, theminoritymindset.com, or check out the description of this video. There's so many recommendations there that are companies that I use myself. So now you're putting money to work. That is the simplest way to invest. The alternative is now you're looking for good investments and you're actively investing your money. You can do either one. Just understand that actively investing has more upside, but also more potential risk. So just knowing kind of where you are as an investor and how involved you want to be with your investments. The last thing that I want to mention here, because I just did a podcast and this topic came up, was now planning for retirement, is your 401k enough? And unfortunately, the answer is no. Many times we assume that your 401k is enough and all you need is a 401k, a healthy 401k to retire wealthy, but that's not the case. Your 401k was never designed to be your sole retirement plan. In fact, the founder of the 401k has come out openly and he has said that the 401k has become a monster and that the 401k has gone awry because so many people who are investing in the 401k think that their 401k is going to be all they need in order to retire successfully with their Social Security. That is a big, fat lie. It is not enough. You have to invest your money yourself. So, if you have a 401k, fine. It's an okay place to start. But you need to do more doing the things I just talked about. Now, you're putting your money to work. So you built the mindset. You built the foundation. You're putting your money to work with your investments. What's next? Now it's all about how do you spend your money the right way. because you don't want to get back into a situation that puts you in financial trouble in the first place again. This would mean now understanding the difference between being able to afford something and being able to buy something. Because if you have $1,000 in the bank, or even if you don't have $1,000 in the bank, you can walk into the Gucci store and buy a $1,000 handbag. But that doesn't mean that you can afford it.
Mm-hmm.
Because guess what? They'll be more than happy to open you up a line of credit to buy their new handbag. They'll be more than happy to purchase it, let you purchase it with your credit card. So nowadays, you can do this buy now, pay later, whether it's through a buy now, pay later app, whether it's through a credit card, whether it's through financing. It's very easy to buy whatever you want now and worry about the price later. But that's part of the reason why so many people are broke and have a very tough time becoming wealthy, is because you're buying all the stuff that you can't afford today. So we're going to flip the script. So if you're going to buy something, you got to make sure you can afford it first. And what does that mean? That means if you want to be able to afford something, well, you got to be able to actually have the cash to buy it. The simplest rule of thumb that I have is my rule of 5, which is if you can't buy 5 of them, you can't afford 1 of them. So you want to go out and buy a $1,000 Gucci bag? Fine. Do you got $5,000 in your pocket right now to buy it? If no, you cannot afford it. The only exception to this rule would be your house, because now if you want to buy a house, yeah, you might need a mortgage for that, and I don't expect you to have 5 times the house value, and you could potentially make an exception for your car if it's necessary. Personally, for myself, I don't make that exception. But again, now it's going to be very difficult if someone wants to buy a $20,000 car to have $100,000 in their bank account. It's not accessible for everyone. But besides those 2 big purchases, you don't want to make any exceptions for your luxuries in life. So you want to be spending money smartly. And now you can also make the decision now, is it worthwhile for you to pay down your house or not? Because now maybe you have some extra cash and now you're thinking, should I invest my money or should I pay down my house? And a lot of people out there are going to tell you one thing or the other, that this is the best thing for you to do. But I've never tried to be one of those people that say this is the one way that you need to put your money to work, or the one thing that you need to do in order to become wealthy. Because you have a different financial goal than mine. You have a different financial background than mine. You have a different risk tolerance than mine. You have different opinions than me. So what I'm saying is get financially educated so you can make a better decision for yourself. So now when we talk about should you pay down your house or should you invest, you got to ask yourself, what type of lifestyle do you want to live? What is your risk tolerance? Now financially, it's a simple answer. If your mortgage is 5% a year and you can grow your money, you can invest your money and get 5% plus X a year, it's profitable for you to invest your money and then use your investment profits to pay down your mortgage, because now you have some profit for yourself. But what's the risk here? Well, when you invest your money in the market, sure, you can get a 10% return, but remember, it's 10% over the long term. Maybe that means you lose money this year.
Mm-hmm.
So are you able to handle that risk? Versus paying down your mortgage, you get a guaranteed 5% return, because when you pay down your debt early, you get a guaranteed return. You don't get a guaranteed return when you invest your money, so
Right.
it comes with risk. So what does that mean? Goes back to your lifestyle. If you're the type of person that says, you know what, I just want to be free. Like, I don't want to stress about money. I want to be able to walk into my backyard, take a deep breath, and know that I don't have to worry about my mortgage payment. If you just want to be financially free and not have to stress about money and don't care about all the lavish and nice stuff, you just want to be free, pay down the house. If you say, Jaspreet, I want the nice stuff. I want to live big. I want to go for it all. I want to dream much bigger. I want the nicer stuff. I'm dreaming big. Fine. There's nothing wrong with that. But just understand then that you got to be willing to take on more risk. More risk, means now putting that money to work. You don't want to be going for the small 5% returns. Now you want to be going for something much bigger. Is it riskier? Yes. That's why it's called risk. But, understanding that, your actions have to match your goals. And, we all say we want to become successful, but you have to put in the right steps that match your words, because you can't speak out of both ends of your mouth here. Like, if you want to become successful, you want it all, you got to be willing to take on risks and put in the work to do that. Like, it's just a matter of aligning your actions with your goals and what it is that you want to do. Like, if you don't care about having it all and you're taking all these crazy risks with your money, what are you doing? Like, you got to ask yourself these questions and make sure you're aligning your lifestyle and your actions with your goals and your risk tolerance. The next thing is now going into your income side. The reason why I talk about it here is because many times, actually a lot of times, if you ask most people, what's causing your financial struggles right now? Every single person is going to say, I'm not making enough money.
Right.
It's just a very common thing where it's income problem, not an expense problem. However, the reality for the vast majority of those people is it's not an income problem, it's an expense problem.
Mm-hmm.
Because what happens is you assume, oh, if I just made some more money, then I can pay down my debts, I could do this, I could do that. But what happens to so many people is you make more money and then your expenses go up. You need a nicer car, you want to go on a vacation, you want to do this, you want to do that, you want to celebrate because now you have a bigger income. And now all of a sudden you had a bigger income, but your expenses went up magically to align with your income. This is what keeps so many people broke, which is why before we talk about the income side, it's about the education side, because until you know how to spend your money, earning more money is not going to have the biggest impact.
Mm-hmm.
Yes, earning more money can help only if you know how to use that money. And so now, how do you earn more money? Well, this can be providing more value at your job. Maybe you start a side hustle. Maybe you start your own business. I mean, there's so many different ways to earn more money, especially now because of the internet, where you got to find something that aligns with your goals. Because at the end of the day, your income is a byproduct of the value that you provide. The more value that you can provide, the more that you can earn. Now, you're really starting to kind of build this wealth, right? You're starting to figure out how to do it, because the more income can help you increase how quicker you become wealthy because you have more money to put towards your investments. But you started with the mindset. Then we started saving and paying down the high interest debts. Then it was all about putting your money to work, becoming wealthy through investments. Then it was a matter of spending. How do you spend your money the right way? Then it was a matter of how do you earn your money the right way, which then leads us to how do you now protect your money the right way? Because the reality is, I talk about this a lot, is as soon as people realize that you have money, they're going to try to take their hand, put it in your pocket, and grab some for themselves. It's nature. I'm an entrepreneur, so I look for different types of opportunities than somebody else might. So if you are an employee, there's going to be different opportunities for you. If you're a business owner, there's going to be different opportunities for you. If you're an entrepreneur, there's different opportunities for you. So I invest my money in 5 places. I invest my money into my own business. I talked about market briefs. I invest my money into real estate. I invest my money into stocks. I invest my money into crypto. Then I invest my money into physical gold. This is the order that I invest my money into. This is my type of diversification. Now, I do have some cash. I always have some cash put aside for things going wrong, investments. I always have some cash putting aside there. And what I've been doing is I passively invest my money, meaning no matter what's happening in the markets, whether the market is up, whether the market's down, it's automatically
every month you have a certain amount going in it. Yeah.
And this is happening into stocks, into crypto, and into physical gold. That does not change. That never changes. So I get paid. Money is automatically invested no matter what. Then in the past, I've had my more active strategy where I would take money and actively go out and buy real estate. I'd actively go out and buy stocks. And in this situation, I'm looking for good deals, meaning a good price. So I haven't been doing that as much recently, not because of what's happening in the market, but because I see more opportunities for me in the entrepreneurial business side. So I'm going to talk about tax for 1 second, if that's okay, because This is a very interesting thing happening right now, because going off of inflation, President Biden just signed something called the Inflation Reduction Act.
Was that 80 billion or something? Or
it is a huge, I think it's even bigger than that. 80 billion is just the IRS.
The IRS.
Side. So the tax side.
So they're investing 80 billion in the IRS to start auditing more people, essentially, right? To start trying to get more money from people.
And that's only one part of the Inflation Reduction Act. So let's go big to go small, because the Inflation Reduction Act is supposed to reduce inflation. That's what the name says. I'm laughing because it's kind of silly, because how do you reduce inflation? You spend less money because the government has spent so much money they didn't have, which caused money printing.
And you tax more people, bro. You collect more.
Exactly. So that's how do you now pay off all this debt? Remember, the government doesn't make money. They tax you, they tax me, they collect taxes, and then that's what they use to pay off their expenses. Now, it's not surprising that the government is running into an issue because they have almost $31 trillion of national debt that they need to pay off. This is not fixed rate debt. So as interest rates go up, their payments on this debt go up as well. So what does that mean? Well, if they have this pool of money, either they're going to need to inject more money into the government, the Fed has to print more money, but they can't do that anymore because of inflation, or they're going to need more tax dollars. So that's one of the reasons why through this Inflation Reduction Act, one of the things they want to do, which is one of the most financially interesting topics, is they want to invest very heavily, billions of dollars into the IRS to help them beef up and collect more tax dollars and past tax dollars. Now, I do want to clear up some of the false information out there because the act is working to hire 87,000 more IRS workers.
That's crazy.
It is crazy, especially considering that today there are about 80,000 IRS workers.
So it's a double.
Yes and no. So the 87,000 people that they're hiring are not all IRS agents, and they're not all being hired today. They're going to be hired over the course of 10 years. And the whole idea is, this is what they say. Again, this is what they're saying. What might happen is it could be a little bit different.
Right.
So I want to be just completely transparent because I don't want to mislead people. I want to make sure everyone's fully understanding what's happening. What's scheduled is about 50,000 or so people in the IRS are scheduled to retire over the next 10 years. So these 87,000 people are supposed to replace them and beef up the agents that are actually going to be doing the auditing to go and collect more money. Now, even if 50,000 people retire, that's still adding almost 50% more people to the IRS. Who are they going after? Well, they say the wealthy, the super rich. And there's about 1,000 billionaires in the United States.
Yes.
Do you need tens of thousands of people to go after them?
No.
So you go a little bit deeper. Now, again, what do we look at? History. I look at history to answer the question because they keep saying that we're not going... saying it's not in the bill, it's not written anywhere. This is what they say, that we're not going to go after middle income people or anything like that. Well, in 2021, 50% of IRS audits were on people earning less than $75,000 a year.
Come on.
50%.
50%.
50%.
Wow. How do they know? Is that public information?
Go search it on Google.
Wow.
Google has a lot of information.
50% of the audits were on people that were making less than
under
$75,000
a year.
Wow.
And
why are they doing that?
well, probably because if you're making less money, you're not going to have the resources to hire a good accountant and hire a good attorney to represent you. So it's a little bit easier, less costs. I mean, it's just easier, right? I mean, you're maybe less financially savvy than somebody who's making $500,000 a year or $2 million a year because now you probably have more resources to defend yourself. So that's a bigger fight for the IRS. And you're probably more protected because you have good advisors who've told you what to do.
Right.
Because now let's say you're making...
You're filing your taxes, you're doing all the right steps, and maybe...
If you make $1 million, once you start making a lot of money, like if you're making over $1 million a year, you're not trying to play the game of trying to hide $10,000 because now you're already under scrutiny.
Yes.
The IRS is trying to see you do something wrong. And so if you try to get $10,000 under the table, it's a bad idea because you already know you're being watched.
So you do everything by the book, you're trying to do the best.
And you have good advisors to guide you to do everything legal so you can pay the least amount of taxes as possible legally. Now, if you're making $50,000 a year and you have a side hustle making you $1,000 a year, you might take that in cash because you might say, this is $1,000 a year. You know, it's just the reality, right? You're taking pictures at people's weddings, you're doing whatever, you're making some cash and you're just doing it under the table. And
the IRS wants that $1,000.
And this is one of those things where it's not surprising because if you look at what's been happening over the last couple of years, this has almost like been a foreshadow of things to come because you remember over the last couple of years, we've seen this new rule on Venmo, right? On Venmo transactions where they want all Venmo transactions over $600 or something like that, where now if you're let's say you're a photographer and you're taking pictures at your friend's wedding and he pays you $700 and Venmo has to report that, they want to know that. They never said why, but now you're starting to see all these things start to add up where if you're doing these small things, it's just like things starting to fall into place where, oh, no wonder they started wanting all these details for this. No wonder they started really going after cryptocurrency brokerages. No wonder they really started doing all of this stuff, maybe creating a digital dollar because they want to be able to see every transaction, which means they want to be able to tax every transaction. Now, of course, I can't validate this, but it's just like puzzle pieces starting to come together. And so this is where the tax thing, why is it so important? Because of inflation, because of the national debt. The government needs more tax dollars to be able to go and fund their payments. And so what are they going to do? Well, they're going to try to find the easiest hanging fruit. Is it going after a billionaire? Probably not, because the billionaire is going to say, come after me. I have my resources. Right. I have my army behind me.
All my accountants, they've done everything. Yeah.
We have everything there. Everything is documented because we want to play by the books because we know you're already watching.
Right.
Now, I'm not saying that everything always is right? There's, of course, exceptions to this. But this is where you just have to understand, they say that they're not going to go after anyone making middle income, whatever.
But after you look at the 1,000 or so billionaires. Okay, you got to look at everyone else.
I mean, so this is again, right? That's what we would have to.
And you got
predict.
80,000 people working on it. It's like, all right.
It's just looking at history, right? I mean, history is the best indicator for what's coming. I keep saying that. And I'm sure your audience is getting very bored on the way to me saying this, but I mean, it's the best indicator because I can't look into the future and say what's going to happen, but I can look in the past and see what has happened, and I see that hey, this is what happened in 2021. This is what's been happening because this is just the situation. And so, for me, I've also seen a big difference between good tax advisors and bad tax advisors. When I get scammed, I get screwed over, I get, these things happen. It makes me want to find a new solution. That's how I started Minority Mindset. I got scammed when I started Minority Mindset. I got screwed over when I started my event planning company. I got completely screwed over my first real estate investment deal. Pretty much every part of me had to do with something really bad happening.
Yes.
So I had a really bad tax advisor. He was really just an accountant who filed my taxes and was never on time. And I got this call. It's horrible. It was just a mess.
Yes.
I got a call from my accountant one day. I'm in the office. This is right before my morning huddle. So we have a 9:30 a.m. morning huddle. Calls me. I think it was like 8:45 in the morning. I'm in the office. Says, hey, Jaspreet, how are you? I said, good. How are you doing? He said, hey, listen, I need you to do me something. Can you wire or send the IRS $100,000 by the end of the day today? And can you also send about $15,000 to the state government by the end of the day today? I was like, what? He says, sorry, we had some miscalculations. We did something wrong.
Holy
and we missed
cow.
this, and you need to send this by tonight. And I was like,
jeez.
are you serious? He's like, oh yeah, one more thing. You're probably gonna have to pay a penalty on this as well.
Oh my gosh.
This is a completely true story. Like,
when was this?
this is not, I mean, this is less than a year ago.
Oh my gosh.
And so it's, I mean, it's
That's painful.
It's very painful. And so I'm like, okay, like I was very frustrated because I'm like, what did I do wrong? Like, what are you talking about? He's like, you didn't do anything wrong. And I was like, well, if I'm the one that has to pay this and I'm the one who has to pay the penalty, something's not right here. And so I paid it, and then I fired him pretty quickly.
Right.
Because that's not the way I like to do business. I want everything to be clean, but I also want people who care about what they do. And he was a cheaper accountant.
Yeah.
I got what I paid for. And so I went on the hunt
To
find
top
a
accountant.
good top of the line accountant. And I pay a lot more than what I used to. However, the scenario is extremely different because he has a very different personality about a different persona. And the way it works now is, one, he manages all my books on time and ahead of schedule. So every month he meets with me and he shows me, hey, Jaspreet, here's your profit. We'll start from the top. Here's your revenue. Here's your expenses. Here's what your expenses look like. Here's how they changed. Here's your profit. Here's your tax liability. And here are the things that you can do to limit your tax liability.
That's cool.
Here are, 3 recommendations or whatever that we believe based off of what's happening right now to legally limit your tax liability. And he has given me so many interesting ideas because the tax code is over 2,000 pages long. And I'm an attorney. I studied a lot of tax. It takes a lot of knowledge and education to understand and read the tax code, but then things keep changing all the time. Like even this Inflation Reduction Act is changing corporate tax structure. So you need somebody who literally eats, breathes, and all they care about is tax. And this is this guy, right? And I'm like, dude, like this is amazing. Like I love this because I don't have the time and I don't want to spend my time thinking about taxes and all the cash flow stuff. I want to build my business. I like entrepreneurship. I like this stuff because it gets me excited. It's the way that my brain works. It's the way that it gives me my purpose, right? And so I do that. I like investing in real estate. I like investing in stocks. I'm passively doing it in stocks. It's a matter of now, what is that lifestyle? Now, if I wasn't an entrepreneur, what would I be doing? Yeah, I'd be stacking up cash to find good investments either in the stock market or the real estate market, or to buy a startup because it's very accessible now, thanks to the internet, thanks to all the crowdfunding sites out there. And I'd be passively investing. Like I would not change that. So I think everybody should be doing this.
You can put $100 a month away into stocks or into an automated account that is investing for you.
Did you know if you're 21 and you start investing $100 a month and you never change that, and you just get a 10% return on your money, which is the average stock market return, and you do that until you're 65, you will retire a millionaire.
Come on.
We're talking about less than $4 a day. If you're finally starting to get paid and now your boss comes to you and says that, hey, you can invest your money in a 401k or a 403 or a 457 and you have no idea what these things mean and you don't know how to invest your money and you want to start investing for the first time, you are in the right place. Making your first investment can be scary and it's a whole new world that most of us are never exposed to. You hear all these terms like the IRA and then the 401k, and then some of you might be hearing about a 403b or a 457b, and now you don't know where to start. Do you take one of these tax-deferred retirement accounts, or do you open up your own investment account, or do you start investing in mutual funds or index funds or ETFs? And so in this video, I want to start breaking all of this down. That way you know how you can start investing for the first time. That way you can make smart decisions with your money. That way you can build up this new nest egg that will make you wealthy. The inspiration for this video came because a good friend of mine who is now a brand new doctor got his first job and is finally starting to get paid, and his boss offered him a few different investment options, a 403b and a 457b, and he had no idea what these things were. He did not know what an IRA was, and so he called me and asked me, how do I make my first investment? This is the first time I'm starting to make money, so what do I do with my money? How do I now build wealth? And unfortunately, regardless of how much schooling you go through, most of us are never taught a thing about how to invest our money to become wealthy. That way we can actually be financially free. So here's what I want to do. I want to start by going over the different tax-deferred retirement accounts. These are things like the 401k, the IRA, the 403b, the 457b. I want to go over what they are, how they work, how to invest in them, and then I want to give you my thoughts on them. That way you can get my opinion. After that, I want to go over ways that you can invest your money yourself. This would be things like mutual funds, ETFs, stocks, and then I want to go over alternative investment options. That way you can think outside of the box and know the different ways that you can invest your money. That way you can build your wealth. So let me start here with the tax-deferred retirement accounts. These tax-deferred retirement accounts are the most popular ways for people to invest your money because a lot of these are completely automated. When you invest in your 401k or your 403b or your 457, a lot of times you're going to be working directly with your employer, and now your employer is going to help you set up this account, and anytime you get paid, some of your money is directly going to go into your retirement account, and this money is going to sit there until you hit close to retirement age, and then you will be able to pull your money out. The reason why people like these tax deferred accounts is because they are tax deferred. You have the option to not pay any taxes on the money that you invest today, or you can pay your taxes today, and then you don't have to pay taxes when you pull your money out in the future. So within all four of these accounts, you have a traditional version, and then you have a Roth version. The traditional version, so a traditional 401k, traditional IRA, traditional 403b, traditional 457b, all these things mean that you do not pay any taxes today. You invest your money today, and then this money gets to grow tax-free. So every time you make a profit, you don't have to pay taxes on it. And then when you start pulling this money out when you're a whole lot older, that's when you pay taxes, when you pull the money out. With the Roth, it's the opposite. With the Roth option, Roth 401k, IRA, 403b, 457b, you pay taxes on your money today, and then this money goes into your account. I'm going to go over why the tax difference matters and which option is better for you in just a second, but let's start by going over what the difference between these different retirement accounts are. So your 401k, your 403b, and your 457b are all essentially the same thing. It's just who can offer that plan. Your 401k is typically reserved just for your private companies, your private employers. You do see some government companies or some big nonprofits offer 401ks, but most of the time it's only going to be a private employer. Your 403bs are for government employees and for your nonprofits. And then your 457 plan is for people like teachers and first responders and city officials. The biggest difference between these three plans is going to be with your 457b, because what the 457b says is if you pull your money out of your retirement account before you are 59 and a half years old, you don't have to face a penalty. But if you pull your money out with a 401k or a 403b before that 59 and a half years old, then you're going to be subject to a 10% penalty on the money that you pull out. So this has a little different rule where you can pull your money out and you don't got to worry about that fee, but you got that fee here. The next major difference isn't on the legal side, it's more on the practical side, because what you're going to see happen with a lot of companies is a lot of companies are going to give you some sort of 401k match. If you invest $100 into 401k, they might give you $30, or $100, they might match $1 for $1, just depending on who your corporation is. But a lot of times
times you're not going to see those types of matches in the 403b and the 457b just because of the way that they work. So a lot of times you're not going to see the same match options here, but you will see that here, which makes the 401k more attractive to a lot of people. So the way that these accounts work is you can open up a 401k, 403, or 457b. Your employer will tell you how. Once you open an account, you will be able to automatically invest some of your paycheck into these accounts. Again, you could do the traditional way or the Roth way. I still got to talk about that. But you can invest your money into these accounts, and once your money is in these accounts, you can kind of decide how you want your money invested. Now, you're not going to be able to invest your money completely by yourself. Typically, what you're going to do is you're going to pick which kind of funds that you want to invest your money in. So you're going to be limited typically as to who and where you can invest your money, because when you open these accounts, your employer is working with some sort of institution on how you can invest your money. So you'll typically get some sort of brochure, some sort of investment pamphlet that will go over your different investment options, and then you'll be able to see where you want to invest your money. And then you'll be able to pick, do you want to be more aggressive with your investments? Do you want to be more conservative with your investments? And based off of that, your money will be invested into these funds based off of what your investment criteria are. The thing that I need you to please understand are fees, because what so many people do not understand about these retirement accounts are the fees that they're paying. Now, at this point, you might be thinking, wait, my 401k is charging me a fee? Yes, they are. When you invest your money into these funds charge a fee to manage your money. And some funds are going to charge you a whole lot more than other funds. So what you need to do is you need to look at something called the expense ratio. This expense ratio is going to tell you what the fees are for the funds that you're invested in. Some of these fees are going to be upwards of 1% or even 2% of your assets a year. That means if you invest $100, they're going to take $1 or $2, depending on what the fee is, right off the top every single year, whether or not you make money. But there are other accounts that will charge you a fraction of that, and they will get you similar returns. So if you have a retirement account right now, do me a favor, open up your brokerage account and see what your expense ratio is. That way you can see what it's costing you every single year. Generally, now this is not something that you need to always follow, but generally, if it's costing you more than 0.75%, that would be considered a high fee. So just something to keep in mind. An IRA works essentially the same as these other three, except now you're not doing it through your employer. You're managing your IRA on your own, because an IRA stands for an individual retirement account. So this means you can go to your bank, you can go to any financial institution, you can open up an IRA, and now you are the one in charge. You're not doing it through your employer. You can create an IRA wherever you want, and then when you create your own IRA, you have the option now to, again, invest the money the way that you want. If you go to a specific brokerage or if you go to a specific bank, they're going to give you their own investment options, or you can create something called a self-directed IRA, where now you have the ability to invest your money yourself. But essentially, the thing that you need to understand about an IRA is that this is a way for you to invest your money on your own and get those tax benefits that people look for with these accounts. Each one of these retirement plans have a contribution limit, meaning there's a maximum amount of money that you're able to invest into these accounts in 1 year. So for example, the 401k, the 403b, and the 457b have a maximum contribution limit of $20,500 in 2022, and the IRA has a maximum contribution limit of $6,000 in 2022. The whole idea behind this is the IRS and the government doesn't want you to take 100% of your income and put it into these accounts, because then you could just not pay any money in taxes on your income today, and the IRS wouldn't like that because they need their tax money. Which brings me to the topic of understanding the difference between a traditional or a Roth investment. So again, a traditional investment means that you're going to pay taxes on the money that you invest, not today, but when you pull it out. And a Roth investment means you're going to pay taxes today, and then you're not going to pay taxes when you pull your money out. The reason why people like this traditional investment is because, well, you don't have to pay any taxes today. You invest your money into your account, you let your money grow, and then when it comes time for you to retire, you're going to pull your money out, and that's when you're going to pay taxes. The reason people like that is because people say, okay, well, when I pull my money out, I'm going to be old, I'm not going to be working a job, so even if tax rates go up, it's not as big of a deal because, well, I'm going to have no income. And if I have no income, then my tax rates are going to be lower. So when I pull my money out, I'm going to have a lower tax rate, so I can pay less taxes because now my money can grow essentially tax-free. And then I pull my money out, and then I'll pay taxes when I have no income at a lower tax rate. People who follow the Roth model will say, well, I don't know what's going to go on with tax rates. I think that because the United States national debt is skyrocketing and I don't see our national government spending slowing down, I think the government is going to want to raise taxes. And if they raise taxes, it will be more beneficial for me to pay my taxes today than when I pull my money out. Plus, you might also be thinking, hey, I'm investing a lot of my money. I'm trying to build more income. I'm trying to build assets. So my goal is when I turn 60 or 65 is not to have a little bit of income. My goal is to have a whole bunch of income when I'm older. So it's more beneficial for me to pay my taxes today because I want to really be wealthy and I want to create a whole bunch of income streams. So you just got to figure out what your goal is and what your financial plan is. If you plan on not doing anything and not having any other income when you're 60 and not having any assets or investments that are going to pay you, then sure, a traditional is going to make more sense. But if you plan on buying additional assets every single year and you plan on building and stacking your additional streams of income, that way by the time it comes to your retirement, you're going to be having a whole bunch of income, well then this is going to make a whole lot more sense. This is what a lot of the minority mindset people do because we're working to build assets. We're working to create new income streams. That way you can make a whole lot of money, not a little bit of money as you get older. Now that you understand how these tax-deferred retirement accounts work, let me tell you my opinions on them because I don't have any of these tax-deferred retirement accounts. I invest my money on my own. I don't use any of these tax-deferred retirement accounts because for me, I can get better tax breaks and get a better use of my money today instead of using one of these accounts. Now let me make sure that I'm very clear with this because what I do isn't for everybody. For the average person, hey, these are fine. But I am very involved with my investments. I like to be active with my investments. I have different strategies and different goals with my investments which give me different tax breaks. And because of that, I don't have any use for these investments. But if you are not into investing your money, if you're not really into being that involved with your money, you're just looking for passive ways to invest your money and you don't want to create whole new streams of income, then hey, this is a great way for you to get some tax benefits and invest your money on the side. I don't like the idea of my money being tied up in an investment where I can't pull my money out if I wanted to. And if I did, I'm going to be penalized. I don't like the idea of my money being tied up in an investment where I don't have a say of how my money is going to be invested. And I don't like the idea of my money being invested into a fund where I can't control the fees or where now I'm subject to higher fees than if I just invested that money into a fund outside of one of these retirement accounts. My investment goals are very different than most people's investment goals because I'm not working for a traditional retirement. I'm investing my money very differently, which is why I don't need these and I don't need to create a fund where I'll be able to access it when I'm 60 years old and then have this nest egg that I can live off of. That's not my investment goal. But again, for the average person, if you're just starting off, this is a great way for you to start, but this should not be your sole investment plan and it should not be your sole retirement plan, which brings me to number 2, investing your money yourself. You do not have to invest your money into a tax-deferred retirement account or to a 401k to invest your money. There are ways for you to invest your money outside of these accounts, and if your employer is not giving you a match or if they're not giving you free money to invest into one of these retirement accounts, then you might get some extra benefits by investing your money yourself because now your money is not tied up anywhere. Now, you're not going to get the same tax benefits here than you would if you used a 401k or an IRA or a 403b or a 457b, but now you have the full control over your investments and you can access your money anytime you want. There are 4 very accessible ways for you to invest your money into the stock market without going through your traditional tax-deferred retirement account. You can invest in a mutual fund, you can invest in an index fund, you can invest in an ETF, and you can invest in stocks. All of these things allow you to invest in stocks just in different ways. So the stock market is a place where you can go to invest your money into your favorite companies, and it is a way for you to bet on the future of our economy. So if you think the economy is going to go up, well now you have a way to invest and get a share of that upside by investing your money into the stock market. If you go out and you buy one share of the Amazon company, well now you become one of the part owners of Amazon. The reason why this can be intimidating or this can be hard is because a lot of people don't want to spend the time, effort, or research trying to figure out which company to invest in, or they don't want to be an investor themselves. They just want it to be passive. They want to invest their money and get some of the upside. This is why things like the 401k and the IRA have become so popular because they are a very passive and easy way for someone to just invest their money and let their investments do their thing. But the thing that you have to understand is that your 401k and your IRA were never intended. They were never intended to be your sole retirement plan. Even the founder of the 401k has come out and said that the 401k has gone awry because everybody believes that the 401k is all they need in order to be financially successful when they retire. But that's not the case. You're going to have to invest more money outside of your 401k, which means you need to invest your money yourself. But that doesn't mean that you have to be doing stock picks. It doesn't mean you have to actively manage your investments every single day if that's not what you want to do. There are other ways for you to invest your money outside of your tax-deferred accounts, which are also passive. Mutual funds, index funds, and ETFs all work very similarly in that they are a basket of stocks. When you invest in any one of these 3, what you're doing is you're investing into a fund that's giving you exposure to a whole bunch bunch of stocks. So instead of you trying to invest in 100 different companies, you can invest in a fund that's invested in 100 different companies, and now you're getting exposure to these 100 different companies without having to actually invest in every single one. The whole idea here is you are limiting your risk because now you are not trying to figure out which companies to invest in. You're putting your money into a fund, and these funds invest in a whole bunch of companies. It might be 30 companies, it might be 500 companies. So this fund invests in a whole bunch of companies, and you're getting exposure to all these companies to lower your risk. That way now, if one of the companies in your fund goes bankrupt, you're okay, because now you still have a whole bunch of other companies which are going to help balance out that loss. Each one of these funds work a little bit differently. A mutual fund is known as an actively managed fund, which means that now this fund has a manager, a money manager, who is getting paid to now find the best company to invest in. So this person is now going to be buying and selling stocks, they're going to be researching companies, and they're going to be trying to get you the best returns possible. That's what a mutual fund is. An index fund and an ETF are passive investments. That means instead of having an expensive money manager, you have a computer, and this computer has an algorithm, and this algorithm is going to say, okay, we want to invest in, let's just say, the biggest 500 companies on the stock market. And now if one of the companies in your list goes lower or they go bankrupt, this computer is going to kick that company out and put a new company in. So it's passively managed, which means that here and here, your fees are a whole lot less than here, because now you have to pay for an expensive money manager. So this is one of the reasons why people really like ETFs and index funds, because your fees are a whole lot less, and most money managers, most mutual funds cannot outperform the market year after year after year, especially after you factor in the fees. So here with this and this, you can just get exposure to the market. When the market goes up, you get the same returns. When the market goes down, you will also see your fund go down. There are ways for you to invest in the general stock market. There are ETFs and index funds that give you exposure to the general stock market, and your fees are a whole lot less. So here, you're paying less fees, and you can get the general returns of the stock market, versus here, you're trying to beat the stock market, but you're gonna pay higher fees, and most money managers cannot beat the stock market over the long run. ETFs and index funds work very similarly, except the way that they trade, because ETFs trade differently than index funds. ETFs trade just like stocks. You can buy and sell shares of an ETF just like any other stock. You can buy it in the morning, sell it in the evening if you wanted to. Don't recommend doing that, but you can. And you have no investment minimum to invest in an ETF. Sure, you just need the money to buy the share of an ETF, unless you're buying fractional shares of it, but you have no investment minimum. Versus an index fund, you're typically going to have some sort of investment minimum. It might be in $1,000, it might mean $10,000, depending on which index fund you're investing in, but you have an investment minimum, and you can't trade it the way that you can in ETF. With an index fund, it's not trading all day long. It usually just makes one trade in the morning, and that's it. So if you want to sell your index fund, you would have to wait until the next day, as opposed to an ETF. You can trade it just like any other stock. In terms of your actual investment though, you're getting the same thing here and here. You're both getting your low cost to invest, and you get kind of the same investments. Like you have ETFs that give you exposure to the top 500 companies in the stock market, and you also have index funds that give you exposure to the top 500 companies in the stock market. So the whole idea with index funds is it's really made just for the long-term investor who is not interested in trading. It is just a very passive way for you to invest your money for the long term. With ETFs, same concept, except now you can trade in and out of it very easily. And then you have the ability to invest in individual stocks. So these are more of your long-term, your passive ways to invest your money in the stock market. If you don't want to be an active investor, if you don't want to research companies, if you don't want to keep up with all the financial news, hey, just invest your money in any of these three, and now you have an additional way to invest your money. You just keep putting money into these investments every week or every 2 weeks or every month. You're just going to keep investing in these things when the market is up and down. You're just going to keep putting money in there, and you're going to let your money grow and compound over time. So that's the strategy here. With stocks, it's very different. If you want to be more active with your investments, you have the ability to earn more money, because now you can try to find the best companies to invest in. Now, obviously, that has more risk, because you can invest your money into a company and then see it go bankrupt, and now you lose your whole investment. But you also have the ability to earn more money, because now you can invest in a company before it really just takes off. Because if you can research companies, you find a company that you believe is hot, and then it takes off after you buy it, well, now you get to share in all the upside, because you are an owner in that company. The mistake that so many people make when they're investing in the stock market is, first they ask, okay, I want to invest my money in the stock market. What stock should I buy? Instead of trying to figure out, okay, what is my strategy? What is my goal? How do I want to invest? They just want to know what stock do I buy. And then what happens is they buy on emotion. They say, yeah, I want to be a long-term investor because everybody knows that your long-term investors make the most money sustainably. You can make a lot of money in the short term as a trader, but traders also lose a lot of their money. I mean, something like 80% of traders end up losing money over a period of 12 months. But now you say, okay, I want to be a long-term investor because I know that's how I can make money. That's how Warren Buffett made all his money. I want to be a long-term investor. And then you find a hot stock to invest in. You put your money in there, and then 4 months go by, and you see your stock in the red. You see your stock down. And now you start to panic. They have a bad earnings, they have a bad quarter, and now you start to get really worried. You don't know what's going to go on with this company. You're losing money, and now you sell. You panic, and you just get out, and now you lost money. This is where you need to have a strategy, and again, why if you want to be investing in stocks, you have to understand what that entails, because now you need to be doing the research. The way you do that as an investor is you have to look at the fundamentals of a company. That means you need to understand the cash flows. You need to understand the profit and loss. You need to look at all the financials. Look at the numbers. Are they profitable? If so, how are they profitable? How much money are they making? Where are their expenses? Where are they investing? If they're not profitable, how do they plan to be profitable? So you want to look at the numbers, come up with a valuation. Then you also have to look at the non-numbers. You need to look at the company itself. Who are the executives? Are they innovating? What kind of products are they creating? Do they have a loyal fan base? How hard is it for another company to come in and compete? What is their real secret sauce? What makes them special? If you can come up with this and you can come up with a good valuation, then you can look at the actual trading price of a company, and then you can say, hey, I think this company is undervalued and it has a lot of upside. And so that will be an opportunity for you to invest. But if you look at the numbers and you say, I think this company is too expensive. I don't want to invest. These are the type of questions you need to be asking yourself, and this is what every fundamental long-term investor is doing. They're looking at companies, they're trying to see what these companies are doing, and they want to value these companies based off of their own metrics, and based off of that, if the company is trading for a price that is lower than what they think their valuation is worth, then they're going to come in and buy. If the company is worth more than what they think is worth, then they're not going to buy. This is what you need to be doing as an investor, and it takes time and it takes practice. Number 3, alternative investments, because there's more ways for you to invest your money outside of the stock market. I love investing my money in real estate. I also have money in cryptocurrency. I also have money in commodities like physical gold, and I also invest in startups and other businesses. There are ways for you to invest your money outside of the stock market if you want to be more involved with your money, and these allow you to get paid in a variety of ways. Let me start by talking about real estate. When I invest in real estate, I don't just buy a property with the goal of trying to sell it for a huge profit. When I buy property, my goal is to get cash flow. So if I buy a property for, let's just say $150,000, I'm going to buy this property not with the intention of selling it for $200,000. I'm buying it because now I know that this property is going to rent out for $1,500 a month every month, and now what I've done is I've created a new passive stream of income. So now I own this asset, I own the real estate, somebody's gonna live there, a family's gonna use this property, they're gonna live there, they're gonna get the value out of this property, and in exchange, they're gonna pay my company, my real estate company, rent every single month. And now $1,500 is coming into my account every single month, and I don't really have to do any work. I have a property management company who I've hired to do all the day-to-day work, and they're the ones that when something goes wrong with the property, they call the property management company. So yeah, all the $1,500 isn't profit. Some of that money is going to the property management company. Some of the money is going to taxes. Some of the money is going to go to maintenance fees and management fees. And if you have a mortgage on the property, some of the money is going to go to debt. But if you do it right, it's also going to put some money in your pocket every single month passively, and now what you've done is you've created a new stream of income. Plus, as an attorney who's not your attorney, I can tell you that real estate also offers some of the best tax breaks that our tax code has to offer. So when you invest in real estate, not only can you get cash flow, but you can also get legal tax breaks. With cryptocurrency, it's very different. Cryptocurrency is a much more speculative and it's a much more risky and volatile investment in the sense that you can see cryptocurrency rise and fall very fast. But you have to understand, again, why are you investing? I like cryptocurrency because it's the people's movement of money. People are losing their trust in the Federal Reserve Bank, they're losing their trust in the Treasury Department, and so people are looking for alternative ways to store their money, to store their wealth, and one of the ways that they're doing that is with cryptocurrency, and you also have a lot of powerful technology behind cryptocurrency. Again, very risky, and if you don't know what you're doing and you just dump your money into it, then you might be very disappointed if you see cryptocurrency prices go down. Again, this is where education is so important. With gold is very different. I own physical gold, not a gold ETF, but actual physical gold, and I look at gold as real money. I don't look at gold as an investment. I don't care if gold prices go up or down. For me, gold is real money because it represents a store of value. It takes time, effort, and labor to mine an ounce of gold, so it really represents value as opposed to our dollars, which aren't backed by anything tangible. It's not backed by gold or silver or anything else. It's backed by a promise by the United States government that our dollars have value. And because of that, the value of our dollars can be manipulated, they can be diluted, and so I own physical gold as a protection against that. But again, I don't look at gold as an investment that's going to make me rich. I look at gold as an asset, as a money that I keep as a store of value. And then I invest in businesses because I'm an entrepreneur and I love working with other entrepreneurs. Obviously, we have here Minority Mindset, a company, but I also invest in other startups. So I like working with other startup founders. And the way that I work with these companies is not just by giving them cash, but I like actually working with the companies. I like working with the founders to help advise them, to help them grow. That way we can take this company and help solve more problems, which will help the company grow even bigger, because an entrepreneur's job is to solve a problem. If you can solve a problem for a lot of people, well, now this company will be able to grow bigger. So this, again, is highly risky. You can lose all of your money by investing in startups, but you also have the ability to earn more money, because now if a company that you invested in grows big and then they go public or they get acquired, well, now you can get a big payday. But again, highly risky, and you have to be involved to understand what you're doing, and you have to be willing to understand and take that risk. Now, some of these can be very hard to do. Like investing in real estate can be difficult because you need access to a lot of capital. And investing in businesses can be hard because if you want to go and invest in a startup, you might need a lot of money or have the right connects to do that. And investing in gold can be hard because you don't know where to do that. So these things can be difficult, but technology has made it easier for the people that are willing to learn. For example, with real estate, you don't have to invest in physical real estate to get exposure and the upside of real estate. You have platforms out there which allow you to invest in crowd-funded real estate. That way now, you don't have to buy an entire property. You don't have to be the person that deals with tenants. You don't have to be the person that gets the call when the toilet is broken. You're just investing into a fund which gives you exposure to that type of real estate. With businesses, before, if you wanted to invest in a startup, you had to go and find the companies and go pitch to the startup or have the startup pitch to you. Instead, then you had to find the right companies. They'd have to come to you and make a deal to invest in them. Now, thanks to crowdfunding, you can invest in startups with as little as like $100, and now you can go and invest in some of these companies. Again, highly risky, but now you can get exposure to these companies at an early stage. That way, if they go big, you got in early because now you were able to do that thanks to technology. The key for any of this to work is that when you get paid now, you have to allocate a portion of your money to your investments. If you're just getting started, that might mean the 401k or IRA or 403b or 457b. But as you start to be more involved and as you start to see the upsides of investing and as you want to be more active in your investments, you might say, hey, I want to see what other investments there are, or how can I be more involved with my investments, or how can I invest my money myself? This is where you have to understand, okay, I'm getting paid, you take a portion of your paycheck, this is money that I have to invest. Now you can see all the different places that you can invest your money, because different investments will have different upsides, different goals. Real estate is cash flow. Gold is preservation of your wealth. Cryptocurrency, you're trying to see more upside. In business, you're trying to see more upside as well by investing in these early stage companies. So every investment has a different goal, and when you have that goal, now you just need to understand where you want to invest. And this is where your financial education comes in, but it all starts with understanding how to take that initial money and knowing where to put it. That way you can start to see that upside and start to use your money as a tool to build your wealth. Financial planning is one of those things that we're all expected to know how to do, even though most of us are never taught how. Well, maybe if you had financially savvy parents, they told you to save a little bit of money, and maybe if you're up for it, invest a little bit of money too. The problem is, if you don't give your money a plan, then your money will leave. Money, where'd you go? Come out, wherever you are. The majority of people have a 3-part financial plan that looks something like this. They make money, and then they spend money, and then they wonder where all their money went. Okay, money, you can come back now, but it doesn't have to be like that. Look, if you can order Chipotle with extra guac and get it delivered to your doorstep without ever leaving your sofa, then you can come up with a budget that will help you build your wealth. You just want to make sure that your budget sets you up for building wealth instead of just getting by, because there's a big difference between these two types of budgeting. The first thing you need to do is figure out where all your money is going. Money where... Oh, there you are. Why do you keep hiding from me? This is the part that nobody likes doing, because you're gonna have to talk with yourself about your spending habits. What did I tell you about paying $700 for scarves? It's almost like when you were in high school and then your teacher would pass back your test results and you would see that, oh my god, you were so close to an A, but you had made 15 careless mistakes. Maybe that was just me, but you have to do the same thing now with your money, except you have to be the one that grades yourself. We're gonna do this the old school way, so I want you to clean off your kitchen counter and bust out your bank statements, your payroll statements, and your credit card statements. Now, write down how much money you made last month, and then write down where all of your money went. So write all of your expenses, and write how much money you saved and how much money you invested. Wow. Before you can make a plan on what to do with your money, you need to know where all your money is going. So guac is really extra, huh? Hopefully looking at your money is going to be the inspiration that you need to go out and make a better plan with your money, because that's exactly what we're going to do now. An average financial plan does two things. It tells you how much money you can spend, and it tells you how much money you should save. A good financial plan does three things. It tells you how much money you can spend, it tells you how much money you need to invest, and it tells you how much money you need to save. A great financial plan automates your good financial plan. You got to come up with the best ratio of spending, investing, and saving for you, or you can follow our 75-15-10 or 50-30-20 plans. If you are older and you have financial responsibilities, you can follow our 75-15-10 plan, which says that for every dollar that you earn, you can spend a maximum of 75 cents, you should be investing a minimum of 15 cents, and you should be saving a minimum of 10 cents. If you are younger and you don't have financial responsibilities, this is your time to double down and build your wealth, so you can follow our 50-30-20 plan, which says that for every dollar that you earn, you can spend a maximum of 50 cents, you should be investing a minimum of 30 cents, and you should be saving a minimum of 20 cents. The easiest way to force yourself to stick with your plan is to automate it and create 2 or 3 different bank accounts. One bank account is going to be your checking account. This is the money that you can spend. One bank account is your savings account. This is your money that you're saving for emergencies. And one bank account could be for your investment money. I say that one bank account could be for your investment money because it depends on your financial goals. Some of you might just want to be very passive investors, where every month a percentage of your paycheck is automatically invested for you and you don't want to be hands-on with your money. If that's you, then you don't need a separate bank account for your investment money, because this money can automatically be withdrawn from your checking account and just go straight to your investment account. If you want to be more active with your investments and you want to pick and choose what your investments are, then it helps to have a third bank account where you take the cash that you want to invest and put it into this bank account. That way you can easily see how much cash you have waiting to be invested. The reason it helps to have a different bank account for your spending money and your saving money and your investment money is because you don't want to accidentally spend your investment money on a new TV. Your spending account has all the money that you're allowed to spend. So this is the money you can spend on your rent, your mortgage, your groceries, charity, and everything else. Once the spending money is gone, you're not allowed to spend any more money. That's it. You got to know how to live below your means. Your investment money is the money that you're using to build your wealth faster. You can use your investment money to pay down your debt faster. You can use it to buy stocks or real estate or start your own business. The main thing with your investment money is this money needs to be used to buy assets, which are things that pay you. You do not want to use your investment money to buy liabilities, which are things that just take money away from you. And your saving money is your emergency cushion. This is the money that you can tap into if you run into a tragedy or if you lose your job. This is the cash that you have to protect you from these emergencies. But here's the catch. You don't want to just save your money just to save it forever, okay? Your savings are losing value to inflation, so you want to be thinking bigger. Once you have 6 months worth of expenses saved for an emergency, this is not money that you're saving for a down payment on a home or something else. This is just cash you're saving for an emergency. Once you have 6 months of these expenses saved, now you want to start thinking about reallocating the saving money either to your investment or maybe a little bit to your spending money too. Making a budget is the easy part. The hard part is sticking with it. Thankfully, we're in a digital age and you can turn your good budget into a great budget by automating this whole process. If you know that $5,000 are coming into your bank account every single month, then you can create automatic transfers that move 15% of this $5,000 or $750 into your investment account, and you can move 10% of this $5,000 or $500 into your savings account automatically. Now you're putting your money to work in the right places before you even get a chance to spend it. Now when it comes to spending, you are forced to live below your means because you have less cash left over in your spending account. Your savings are slowly building you a cushion, that way you have something to fall back on in case an emergency happens. And for your investments, well, this is where you need to know yourself and your risk tolerance. The most risk-free way to invest your money is to pay down your debt faster, because if you're paying 6% a year in interest on your student loans and you pay off your student loans a year early, well, you just got a guaranteed 6% return on your money, because that's 6% in interest that you don't have to pay to your bank. If you want to be more of an active investor, but you don't really want to go into the details of analyzing companies and stocks, then you can look into investing in index funds. You can think of an index fund kind of like a group of stocks. When you go out and you invest in individual companies or stocks, there's a risk that the company that you invest in is going to go bankrupt. And if that happens, your investment is going to go to zero and your investment money is going to be gone. But if you invest in index funds, now you're not investing in individual companies, you're investing in a fund that invests in a whole bunch of companies. Now, even if one company goes bankrupt, you're okay, because there's a lot of other companies in the fund to balance that one bad company out. So this is your lower risk way to invest your money into the stock market, because now you're not investing in an individual company, you can get exposure to the entire stock market as a whole. If you want to be even more involved with your investments, then you can look at investing into individual companies, or my favorite, investing in real estate. This takes more time and effort on your part, because if you want to invest in individual companies, you got to be doing your research to make sure this company is growing and it's a good stock. And if you want to invest in real estate successfully, you got to build a team, you got to know the location, and you got to make sure your tenants are paying rent. Being more active with your investments comes with more risk, but it also comes with more potential return. Look, investing is not a guaranteed thing, okay? You are never guaranteed to make money when you invest. You might even lose money, which is why you have to do your own due diligence, and it's why you want to never blindly listen to a random guy on YouTube. But now you're building a financially healthy lifestyle, that way you can live a wealthy life. It's not easy and it's not a quick overnight thing, but it will work if you stick with it and you work for it. If I had $1,000 to invest today and I was 21 years old or 25 or 28 or in my 20s, I would not invest this money. If I wanted the biggest growth and I want the biggest returns, I would not put this money into the stock market. I would not put this money into real estate. I would not put this money into cryptocurrency. I would not take this money to the casino. I would invest this money into something that would give me the most scalable and the most growth, into something that will pay me consistently with cash flow and equity. The first thing that I would do is I would take this $1,000 and divide it up into two pieces. I would take 10% or $100 and put this into my education side, and then I would take the other 90% or $900 and put this into my actual doing side, what I would do with this money. Now, the reason why I don't want to take this $1,000 and put this money just into the stock market or the real estate market or the crypto market is because if I'm looking for the most growth, and this is me, like the title said, how I would invest the $1,000 in my 20s, well, I want to see the most growth, and that's going to require me to actively work to grow the money because I have the entrepreneurial mind. I want to work to actually create something much more valuable. If I take this cash and I put this money in the stock market or the real estate market or crypto or whatever, well, now I am hoping that I'm going to get a 7, 8, 9, maybe 10% return on my money, because when you put your money into these assets, it's a passive investment. You're putting your money into something else, stocks or whatever, and you're just hoping that your investment is going to grow, and it's something that you don't got to worry about. But if I want to grow this money the most, now I want to take this money into my own hands, put it into myself, and grow it as fast as possible. So first thing I want to do is I want to make sure I educate myself, because the reality is education is the backbone for your success. But the question is, where are you getting this education? Like, most of us assume that school is our backbone fundamental, and that is where education is supposed to end. When in reality, school is just where your education begins. And I can tell you this from experience, because I went through high school, I went through college, I went through a year of grad school, and then I went through law school. And that's when I realized I never once learned a thing about making money. And so I graduated law school and I never worked a day as an attorney. I was an entrepreneur. I was always an entrepreneur since I was in high school. But after I graduated law school, I continued to work on myself and my own businesses. But along the way, that's where I learned that I had to invest my money back into my own real education. I have spent multiple times more on my real education and my business education now than I have spent on all of my formal education. Now, where does this education come from? Now, of course, you can start by watching YouTube videos. It's a free way to start. You can listen to podcasts, another free way to start. But then you can also start reading books. You can start taking classes. Then you can start hiring coaches, and then you can start hiring consultants. And so the more money you make, the more you want to be reinvesting back in yourself. But if you're just getting started, you only have $1,000, start by watching YouTube videos and maybe start by reading some books. Get a few business books, some business books on something that you're interested in, whether it's marketing, whether it's selling, whether it's whatever. Get a business book on that. Get a business book on how to start a business, how to be an entrepreneur. Get a business book on how people have built successful businesses, and get a business book on how to scale a business. Go out and find some of the top business books and things that you're interested in. Just go to Amazon, go wherever, Audible, and see some of the books that have some of the biggest and highest reviews. Buy them, start learning them. Then, at the same time, in addition to you doing, I'll get to that in just a second, you gotta have money to feed yourself, you gotta have money to pay your rent, you gotta have money to buy your basic stuff, and so you're gonna need cash, and $900 is not gonna do it. So if I could go back in time, now I wouldn't change anything that I did because I'm very happy with the things that I learned along the way, because everything that I did, all the failures that I had, all the mistakes that I made kind of got me to where I am today. So I wouldn't change my life for that purpose. But if I was gonna give another 21-year-old advice on things that they could do to start learning more, look for a sales position where now you can work for a bigger company where you can sell something that's scalable. And when I say scalable, I mean something like mortgages or insurance, life insurance, or maybe even stocks, but that takes more licenses in order to get started. Because I used to be a real estate salesperson and it was nice, but the problem is you're very independent. Like you got to figure out all by yourself, which can be good, but if you want someone to teach you while you're working to build your own business, it's nice if you're working for a big firm, something like where you're selling mortgages, and now they plug you into a system, and now you learn from their blueprint. They teach you exactly what to do to sell, they teach you the program, they teach you your systems, and now you learn how they built the business, you learn how to sell, you learn how marketing works, and you're plugged into something where you can see it all happening around you, and now all you got to do is pick up the phone and practice. And you get to practice on somebody else's dime while getting paid, and you can make a lot of money while doing it because now you're learning how to sell, you're learning how the business works, and then you're working on how to build yourself as well. Now, before I get into some of the things that I would do, let me talk about some of the things that I would not do if I was starting back off when I was 21 years old and I wanted to see the fastest growth of my money. The first thing is I wouldn't start a YouTube channel to be a content creator. Now, let me specify what that means because generally you have two different types of YouTubers out there. You have YouTubers who are content creators who live off of the YouTube advertising revenue, who live off of their sponsorship revenue because all they do is make YouTube videos. And then you have YouTubers who are business owners. They make YouTube videos in order to funnel people who watch their videos back into the business. An example of this would be, let's say you're a real estate salesperson and now you make YouTube videos talking about some of the real estate homes that you're selling. And the reason why you're doing this is so that now you can find potential buyers for your homes. And that way people who might want to list their homes will find you. You see the same thing with accountants, you see the same thing with a whole bunch of different industries where people make videos. Maybe you're an accountant, you make videos about finance, how to manage your money better. That way people who want an accountant will then use you as an accountant. So that's one option, is to start a YouTube channel to help service your clients and to find more clients as opposed to actually creating YouTube videos just to be a content creator. Now, I think I'm somewhere in the middle. I started my YouTube channel, This Minority Mindset, as a hobby. I didn't really think of this as a way of making money. I was working on building a completely separate, completely unrelated business. I was in the business of selling socks. It has nothing to do with making money. It has nothing to do with entrepreneurship. It was just something that I was doing. So I started YouTube as a hobby. But then YouTube started to grow, and I found my passion way more here in the whole education side of things. But for me, it wasn't a way to make money. Now, of course, YouTube does pay me. I make money from advertising and sponsorships, and I also use YouTube as a way to send people to my own company, Market Briefs, which is my free financial newsletter company, where now you can get a free daily update on what's happening in the finance and business world. But I don't use YouTube like most people do because I don't need my YouTube advertising revenue. I don't need the YouTube sponsorship revenue. I have my own business. I have my own investments. I have my other things that I'm doing. I like making videos. Otherwise, I wouldn't be doing it. But I'm also not sitting here just funneling people back into my business only. Like I do this because I enjoy it, kind of like on the content creation side, but then I also use YouTube as a way to get people back into my business. Now, if I was 21 years old or 25 or 28 and I wanted to start making money, I wouldn't start making videos for the content creation side because it takes a lot of time, a lot of effort. And unless I wanted to be an actor, I probably wouldn't be doing this. Now, I would potentially use YouTube to funnel people back into my business from the business side, but I'll get to that in just a second. The second thing that I wouldn't do is start a service-only business. I made this mistake multiple times. I don't want to say it's a mistake because I learned from them each time and I made money doing it each time, so I don't want to say it's a mistake. That's the wrong word. But I tried both of these, But the thing that I kept learning was that when I do a service-only business, it's not very scalable. So for example, when I was in college, I started an event planning company while I was working at weddings. And this event planning company was great. I was making good money. I was throwing parties, I was throwing concerts, I was throwing shows. But the problem was if I wasn't physically hosting an event, I wasn't getting paid. So I had to physically be there to get paid. Then I closed that business down because I hated the industry. I didn't party, I didn't drink. I wasn't into that whole industry, but I was very involved on the business side of the industry. So I didn't like it, so I got out. And then I went into wholesaling real estate. I got involved first as a real estate salesperson and then wholesaling real estate. And again, wholesaling real estate was a good business. I was making a lot of money, but it wasn't scalable. I had to physically keep calling clients. I had to keep calling buyers. I had to keep calling sellers. I had to keep going to the homes all by myself. And if I wasn't the one closing the deals, if I wasn't the one taking the pictures, if I wasn't the one doing everything, nothing was going to happen. No one was getting paid. And so it was, again, a service-based business that revolved around me. And by then I had realized that I wanted to build something much more scalable. So it didn't offer me that scaling potential. So I want to do something that's 100% service-based. Third, I would not start a dropship e-commerce store or any sort of e-commerce store where I'm just selling random products that anybody can buy from Alibaba or AliExpress or somewhere in China, because I want to build something scalable that I can protect, that people can't just compete against by undercutting my prices. I have done this. I have bought products from Alibaba and the Chinese sites from manufacturers over there to sell them on Amazon and eBay and other sites, and it made me some money. But it's very difficult to scale and build a real business. So if I'm going to be investing my time into something, I want something scalable where I can keep all the profits. And four, I would not start a super capital intensive business, kind of like Market Briefs that I have now. Now, Market Briefs is a newsletter company. And if I was the only one writing the newsletter, then sure, it would not be very capital intensive. But the way that we have built it is we have people who are writing the newsletter. We have people in charge of the research for the newsletter. We have people in charge of our business development who are getting sponsorships for the newsletter. So it requires a much bigger team. And I wanted to build a business that doesn't require me to physically work in the business to do it. And so for that, it's a more capital intensive business because now you have to pay for salaries for each one. You have to pay for the softwares and all of that. So it's much more expensive now to run. But if I wanted to build a business, I wouldn't do something that takes a whole bunch of money to start because I only got $900. I'm trying to build a business with as little money as possible. That way I can get it going and start putting money into my pocket. Is it possible? Sure. If I had a really good business idea, if I had a really good product idea, then absolutely I would take this money and invest it into that. I would go run it on Kickstarter, try to get some initial capital, then maybe go out and try to raise some money that way I can grow it bigger. But if I don't have a huge business idea, if I don't have this real big passion of building this specific product, then no, I'm not gonna go and try to do that. I'm gonna try to find a way to grow my money much quicker. So what does that look like? If I have to go back in time, then one thing that I might do is continue working in the wedding business, which is a service-based business, or do my event planning company, again, a service-based business, but then add a digital component to it. Now maybe I make videos, take pictures of my events. Back then, Instagram and YouTube were not a thing. People were not using it like the way people use it now. And so now, if I were to go back, if times were now, I would post what I'm doing on social media on YouTube. But there would be a goal for people to watch my videos. So I'd show people my stuff, what's happening either at the wedding or at the event planning company. People would watch it. Maybe I'd generate a little bit of advertising revenue, but then maybe I would add a class on the back of it. If you want to learn how to build an event planning company, if you want to learn how to work at weddings as a DJ or play the drum that I was playing called the dole, charge, I don't know, $50 up to $500, depending on how intense the class is, teaching people how to do the thing that I was doing and how to build a business around it, where now I'm doing my service, but I also have a digital component. If I'm working at weddings, I only get paid when I actually go and work at a wedding, but people can watch my videos 24 hours a day. People can buy my class at 3 in the morning when I'm sleeping. And this way now you start to build a bigger business outside of just what you're doing in the business where you're working at the business. So now you're working at the business, but also teaching how to do the business. This way now you create a whole new stream of income. Instead of just doing one thing, you have a digital stream of income as well. The same thing would apply for pretty much any service-based business. If you're gonna go out and detail cars, if you're gonna be a DJ, if you're gonna help people get into PR, all these things are services where you can add a digital component to the back end. That way now you have a way to get paid instead of you just physically doing the service, but also teaching the service so people can see what you're doing and try to replicate what you're doing as well. If I didn't have a service idea, like if I never worked at weddings, if I didn't host parties, if I didn't work in real estate and do real estate wholesaling, if I didn't have this type of service idea, then what would I do? Well, in that case, what I would want to do is see how I could provide as much value as possible to people who have money and want to spend this money. Who are those people? Well, generally business owners. How can I provide value to business owners who are making money, who want to earn more money? How can I help a business owner do that? Well, for me, my interest, I like marketing. I've always liked marketing. I don't know why. I like the idea of marketing. And so I would probably try to figure out how I could start some sort of marketing agency to help business owners get to where they want to go faster with a specific keyword, specific type of marketing. Now, I know this is not a marketing video or a marketing channel, but let me give you a little bit of marketing 101. On a very broad level, you have two different types of marketing. You have organic marketing and paid marketing. Organic marketing is where you try to get customers without actually buying the customer. So somebody comes and buys a product from you because they hear about you from Google, they watch a YouTube video about you, or somebody tells you about your product and somebody buys it. So you're not actually paying for that customer. Paid advertising or paid marketing is now where you're paying to get exposure. You're paying for advertisements, you're paying somebody to talk about you, that way you can get more customers for your business. Then you can break down the organic marketing into content marketing and referral marketing. Content marketing means creating content on the internet that people find, that way then they can learn about your business. Referral marketing is how you can get your current customers to refer their friends, to refer people that they know to buy your product as well. Then you can break down this type of organic content marketing into things like SEO. How do you get a blog ranked on Google, onto the first page of Google? If somebody searched, I want a good accountant, how do you help this accounting firm end up as the first result? Second would be YouTube content marketing. You are watching a YouTube video right now. In my YouTube videos, I talk about things like my Market Briefs newsletter, the Market Briefs company. This is a form of content marketing because now when I say, if you haven't joined Market Briefs yet, I got the link for you down in the description below. This is a type of content marketing where now some people will read this, watch what I'm saying, and then go join Market Briefs down in the description. Then you have PR. Helping people get onto the news, get somebody featured on Forbes or Business Insider or the local radio station. How do you get people that news feature? Then you have social content marketing, getting people viral on TikTok or Instagram or other social media platforms. Or it's podcast content marketing, getting people featured on podcasts. How can you help somebody get podcast bookings? These are all different types of content marketing that can help a business owner get more sales, get more customers, get more acquisitions. Just like that, you can break down paid advertising into things like Google advertising. How can you get more clients from Google advertisements or YouTube advertisements? Or how about social media advertisements? Facebook ads, Twitter ads, Instagram ads, or sponsorships, getting people sponsorships on YouTube or with Instagram influencers or with newsletter paid advertisements. I didn't realize how big of an industry it was for newsletter advertisements until I entered the Market Briefs newsletter business. Now, if I was going to start a marketing agency, you might think just go out and start a marketing agency and try to do everything because now you can cater to the most clients, you can get the most businesses. But in reality, when you try to do everything, you end up getting nothing. So if I wanted to go back now and start a marketing agency, because I know business owners want to spend money in marketing, because if you can help them get $2 in sales, they'll be more than happy to pay you $1 in order to do that. What I would want to do is I would want to zero in on one particular item and help business owners with that. Help them with social media, Instagram advertisements or Facebook advertisements only, YouTube ads only, newsletter ads only, get people onto sponsors only. Get people with referral marketing. Be the expert when it comes to getting communities to refer someone's product to their friends or people that they know. Be the expert at getting people onto podcasts. Be the expert at getting people into news. If you can focus in on one niche, now you have a much more compelling pitch that you can give to businesses saying, hey, I only work with getting people viral on Instagram. I don't work with Twitter. I don't work with Facebook. I don't work with YouTube. I don't know about any of the other stuff, but I'm an expert when it comes to getting people viral on Instagram. When you do that, you are going to have a much more compelling pitch to people who want that particular product. Now you might say, but I'm cutting out so many potential opportunities. I'm cutting out so many potential businesses. And you're right. But you're focusing in on the right businesses, and it's going to give you the opportunity to charge a whole lot more money because you're very specialized. But it requires you now to learn how to do that one thing. So where do you start? Well, start with YouTube. Watch as many YouTube videos as possible on that particular thing. Again, you could do this with other things as well. I just like marketing, so this is what I would do. I would go out and watch as many YouTube videos as possible, read as many blog posts as possible, and then try to do it for yourself. and then go out and try to find some clients for free. Yes, you want to start for free because you need to get some testimonials, you need to get the experience, and you need to get people who are now going to vouch for you and say, wow, you did a good job. Because now you can take this and publish it on your website. So you have that $900, take that $900 and invest it in your brand. Build a logo, build a website, make everything look nice, and then publish some of these testimonials on your website, and now go and try to find as many clients as possible. The hardest one to find is the first one. Once you find the first one, once you get the first person to pay, now you know you're in business. Now it's a matter of just replicating and scaling what you did to get the first one. And now as you grow, you can hire more people, teach them to grow. Now, of course, this is easy. No, I'm making it sound very simple. It's very hard. Building a business is very difficult. It takes a lot of time, effort, research. You got to keep reinvesting in yourself, but it is very possible. And now what I'm doing is I'm building something that's growable, I'm building something that's scalable, and each individual one of these can be a multi-million-dollar business idea. And each one of these can make you a ton of money, but it requires you to constantly keep learning and keep leveraging it, because now you can be the specialist. You can be the go-to person for the one specific thing. And when you become that go-to person, you can then 10x your rates, 20x your rates, even 50x your rates. You can go from charging $100 to $5,000 for doing the exact same thing, because people want to work with you, somebody who has all the experience, somebody who knows what they're doing, because you have built up that reputation. And this takes time, but it also takes that specialization where you are the expert in one particular category. So if you want to get the biggest returns possible, then you want to be taking this money and investing it in you, and keep investing in your education. That way you have the resources and the skill set. You're investing in your mental equity. That way now you have the resources now to build a cash flowing business that's worth something. That way maybe later on you can sell the business or go out and do something completely different.
If you have $1,000 sitting in the bank and you're trying to figure out the best way to grow this $1,000 into $2,000, the best thing for you to do is not put this money into the stock market. I'll show you. See, if you have $1,000 sitting in your savings account right now, you have a few different options of what you can do. Number one is you take this $1,000, you go to the mall and you buy yourself a new watch. That's spending the money, but now this $1,000 is going to slowly go down to zero. So you're essentially throwing this money in the garbage. Yeah, you got a nice watch, but that watch is not going to appreciate in value. It's going to go down in value. Option number two is you can save this money. Now, if you take this $1,000 and you put it into a high interest savings account that's paying, let's just say 5% in interest, now you're going to generate $50 over the course of a year. Not a ton of money, but better than nothing. It's better than spending that money. But the third option is you can invest this money. And this is where most people think, oh, well, you can put this money into the stock market, or you can put it into real estate, although you're not going to be able to buy a rental property with $1,000 in today's market. So if you put this money into the stock market, now you're trying to grow this money by 7 to 10% a year. That has been the historical average when you invest your money into the stock market. So let's assume you can get a 10% return on the $1,000 investment. That means you invested $1,000 into the stock market. After 1 year, you are going to make $100 of profit. The problem with that is you don't actually make the $100 until you sell your stock, which means you have to sell it, you got to pay taxes, and then you only get that $1,100, but you no longer have an asset. But then the second problem with that is the $100 isn't a ton of money. It's not going to change your lifestyle either. So now the question is, well, how else can you put this money to work and get a return that's going to make you real wealth, that's going to allow you to make even more money, that we can have more money to invest? Because there's nothing wrong with investing your money into the stock market or the real estate market. I want you to be investing your money into these types of passive assets, but I also want you to build true wealth with these passive assets. Because the way that it works when you invest your money into the stock market is you got to make the money, and then the money you make is going to work to earn you more money. The more money you earn, the more wealth you will build. Because if you make, now, instead of $1,000, $100,000, now you can take this $100,000 and put it into the stock market. Well, now a 10% return is $10,000. If you make $1 million and you put this money into the stock market, now a 10% return is $100,000. So you can start to see where that same 10% return starts to become a lot more valuable when you have more dollars to invest. This is why a lot of people say, oh, it takes money to make money. No, that's not true. It takes money to grow your money, but it doesn't take money to make money. And so when it comes to growing your money with these passive assets, stocks and real estate, they are there to grow your money. If you can invest $1,000 a week or $1,000 a month, now you can really start to grow that money because now you're making money and now you can grow that money, and that's where true wealth is built. I don't want you to stop doing that. That's great. But if you only got $1,000 to invest, what you need to do is figure out how you can take this $1,000 that you have right now and grow it. That way now you can take $1,000 every week or every month and put this money into the stock market. How can you take the $1,000 that you have and multiply it so now you can take $1,000 every month and keep throwing that into the stock market? What can you do with this $1,000 today to make that happen? That's what you need to be figuring out, how you can invest that money today. Because if you just put that $1,000 into the stock market today and you don't touch it, well, yeah, you can grow it a little bit. But remember, the stock market and the real estate market are there to grow the money that you've already worked to create. And if you want to be able to grow your money faster and grow more money, you need more money to invest. And this is where, going back to what I said just a second ago, it's important to remember it takes money to grow your money, but it doesn't take money to start earning that money. If you got $1,000 right now, the question is, how can you take that $1,000 and invest it in a way that's going to earn you more money? And this could be investing this money into your education, or this could be investing your money into your income. Now, the way you invest it into your education is pretty straightforward. Take this $1,000 and now invest it into classes, books, seminars, coaching, something that's going to allow you to earn more money. Now, before you go out and you spend this money, I do want to give you a little bit of caveat, because the last thing that you want to do is just throw this into any sort of class or education or coaching on the internet, and then you find out this wasn't right for you. So start with the free information out there. Go out and watch free YouTube videos, listen to free podcasts, and then start reading some books. You got to kind of progress down this in a more gradual way, because you want to make sure that you're putting this money into something that's going to actually drive you and deliver you some value. So start with the free content, YouTube, podcasts, blogs. See what it is that you want to learn more about. Maybe you want to build a personal brand. Maybe you want to build your own business. Maybe you want to get a certificate in data science. I don't know. You figure out where it is that you want to invest more of your time and your money, and then you take it one step further. Before you go out and you spend that $1,000 on some expensive coaching or some expensive class, go out and buy a couple books. Spend $50 and go buy as many books as you can on that topic and then read it. If you don't read it, well then what makes you think that you're going to now get a better return by buying a class that takes even more work and more action on your part? If you can't read the book, you're not going to be willing to put in the work on the more intense and work ethic stuff. So now, go buy a couple books. Spend $50 buying a couple of books or a few books on whatever that topic is, and then read them. And if after those books you are still interested and you're still excited about this thing, that's where now you can start investing more of this money into your education. Now you can look at classes, coaching, seminars, whatever it is, conferences. Look into ways to keep expanding your knowledge, but also doing something on this topic. If it's building your personal brand, you better keep making content. If it's building your data science certificate, well, then you got to start working to get that certificate and figure out what you can do with that certificate. If it's building your own business, then you got to start thinking of business ideas and you got to start implementing it. And this is where now what you're doing is you're investing in your brain, because if you can invest the $1,000 into learning how you can earn more money, well, now that's where now you're working to earn more money, so you have more money to invest. Remember, the key with earning money is not to buy a faster car. The key with earning money is to own more assets, so your assets can buy you the faster car. You want to make money to own more cash flow, because that cash flow can then fund your lifestyle. And I want you to have whatever nice stuff that you want. I'm not saying don't buy a nice car. I'm not saying don't have a big home. I'm not saying don't have the luxury designer stuff. I'm saying afford it first. And if you really want to be able to afford it and be completely financial free, that means you're using your assets to pay for it for you. You're not working to earn money to buy the nice car. You're working to own assets that pay for the nice car. The alternative thing that you can do is you can invest this money into your own business idea. If you want to work to build your personal brand, then maybe you go out and buy a camera, or you go out and buy some lights. But I do want to caution you with this as well, because most of the time, 99% of the time, you can go out and get started and start building your business, your brand, your product with very little amounts of money. I started my Minority Mindset show, this entire YouTube channel, with less than $500. And I say $500 to be very gracious, but I know it was significantly less than that. I didn't have a fancy camera when I got started. I didn't have fancy lighting when I got started. I had my cell phone, my iPhone that I had, and then I had a tripod that I bought off of Amazon. I think I paid $25 for the tripod, and that was it. I don't have any fancy microphones. I don't have any fancy editing equipment. I don't have anything. I used my $25 tripod. I think I might have bought a $25 light as well. So maybe let's just say $50 or $60 to get started with the equipment. I recorded the videos off of my cell phone with no mic or anything. And then I edited it on the free editing software that my computer had. And then I uploaded it to YouTube. And I kept doing that until I started to get more views and started to get some revenue. And then when I got some revenue, that's when I bought my first camera. And that's when I bought my first lights. And then I went out and bought my first microphone. And that was a tough purchase because microphones are expensive. But it wasn't until I started making money that I started really spending money. And this is a mindset you really have to shift, because most people assume, oh man, I can't go out and do this because everybody's got all this fancy stuff and everyone's spending all this money on advertising and this and that to get started. Well, the reality is you don't need a ton of money to get started. It's not the tool set that you lack, it's the mindset. And this is where your mindset is really going to determine what trajectory that you're going to have in business and your income. Because if you want everything today and you're not willing to put in the hustle and the work to get it, well, it's going to be extremely difficult for you to actually put in the reps to get the success, because building business is hard. Building a business takes time. Building a business takes effort. Building a business takes risk. It took me a long time to build my brand on the Minority Mindset Show. And then I had to figure out, how can I build a business? Because I am an entrepreneur. I didn't really just want to be a creator. I've always had this entrepreneurial mind where I want to be a business owner and I want to run a company, because that's something that I enjoy. Not everybody wants to do that. And so I would try a lot of different things. And I was running businesses before the Minority Mindset Show, and I was investing in real estate before. But for me now, I'm building this content. This is fun. It was a hobby at first, but then I wanted to turn it into a business because I was spending so much time into creating this personal brand. So first I started with building a blog, which failed. And then I had the idea to build the Briefs media brand. Now again, if you wanted to go out and start a media company, generally it would cost a ton of money. And most people have to then go out and either raise debt, or you go out and raise investment capital, venture capital from investors. But I was able to self-fund it because now I could take the revenue that I was making from my YouTube brand, my personal brand, and funnel that here into the Briefs Media brand. And then we were able to grow Briefs Media from a free newsletter to then our whole other platform of things that we're working to build. But all these things were like baby steps that built on top of one another. And even before the YouTube channel, I was doing so many things before I got to YouTube. And so now the question is, how can you now start taking action? And the difficult part here is a lot of people assume that you have to be perfect. You have to find the right thing. You have to find the right idea. You have to find the perfect item to do. But that's not how it works. Perfection can be the enemy of great. And this is where now the key is, you just got to get started. And if you do something that you no longer want to do, you can always pivot. But I guarantee you're going to learn something. I started off in event planning. That was my first business. Then I got into real estate. By real estate, I don't just mean investing in real estate. I was doing that. But I also got my real estate salesperson's license. I also became a real estate wholesaler. Then I got onto the internet. I started selling on Amazon. Then I started my own e-commerce store. And after that, after doing all this and investing in real estate, I then got on the internet with my YouTube channel. And so it's progressions. You got to figure out what kind of path you can take and what is going to be right for you. And what's right for you is going to evolve, but you got to get started, and you got to just keep putting in the reps, and you can't keep just trying to be perfect, because if you're constantly just trying to find the right thing to do, you're going to be waiting forever. And this is where you just got to get started. You're going to learn along the way, but you got to start putting in action. So if you got the $1,000, the question is now, how can you take that $1,000 and turn it into something that's going to pay you at least $1,000 a month that you can invest into the stock market or into some other asset class? That way now you can continue to build that wealth, but you have to figure out how you can grow that first $1,000 in the first place. By the way, if you want to learn more about Briefs Media, we have a free newsletter called Market Briefs. Market Briefs is my free daily breakdown of what's happening in things like the housing market, the stock market, the economy, the global economy, and the crypto market into a fun, witty, and easy to read email. You can read this newsletter in less than 5 minutes every morning, and it's completely free. So if you have not read Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I'll also link it for you down in the description below.
Passive income is the idea that you can make money without doing any work. And that whole concept is kind of true, but it's also kind of a lie. There's no true way to create an income that will pay you forever without you having to do anything. There are 3 general ways that I generate cash flow, and some of these are way more passive than others. They are PRR.